Now, the question I get asked every single day is, what are the interest rates? Here's my response to that. So, a lot of people think that the interest rates go up and down every single day. But really, what happens is the cost of the interest rate, fluctuates higher or lower. Let's get further into that. In order to understand all this, we're going to talk about three things: points, a rate stack, and if interest rates don't go up and down, then what is market fluctuation and how does it impact rates? So the first thing is points. Okay. Here we have a screenshot that I took for another lender that shows a 30-year fixed VA purchase at a rate of 6.125%, paying 1.563 points, which equals a cost of $4,610. Now, where you can find this is on your loan estimate or your closing disclosure. It'll be here in section A. The amounts match. And what this is this is a lender fee. This is how much you're paying in order to get that interest rate. So let's take a look at what a rate stack is. All right. So this is what a rate stack is. Me as a loan officer, when I'm going through my different lenders, I take a look at the rate stack and I determine who has the better interest rates. Now, right now, for all intents and purposes, let's just select 6.5%. Selecting 6.5% shows that it is giving a credit of $707 back to the borrower. So what this looks like is 6.5% is what we would consider par. Par rate is as close to the interest rate as you can get without really having to pay anything. There are options to get a higher interest rate. See, let's just say 7%. You can get a lender credit of, let's take a look, $4,587. So if you wanted to go with a higher interest rate, you can get money back from the lender as a lender credit. However, if you wanted to go lower, let's just say 6%, that 6% interest rate is going to cost you $3,885. Now, again, this was at the time when the screenshot was taken. So what is market fluctuation and how does it affect the interest rates? So that same 6.5%, like we said, was a credit of $707 on Monday. Pull it again on Wednesday, that same interest rate of 6.5% now costs $153. Pull it again on Wednesday, again, same lender, same interest rate. It now costs $1,273 for that same interest rate. So the big picture is the interest rates, as I tell everybody, they are a spectrum. It's a matter of how much you want to pay for it and what you would like your monthly payments to be. There's always that balance on your return of investment. But this, not being able to lock the interest rate on a loan over the course of 5 days means that you would be paying almost an additional $2,000 more for the same exact interest rate. So that's where it's our job as your loan officer to look at the market, study the analytics, and see if there's anything coming up, whether it's a job and labor report or the Fed funds meeting, something that may impact the interest rates. So it's our job to get ahead of it and see when is the best time to lock your interest rate for your loan, assuming you are under contract. So I hope you got something out of this. There's a lot more videos to come like this, but this is the number one question I get asked every single day. So I figured it was probably the best video to shoot. If you have any questions, feel free to reach out. Take care.